saying in my language, in my ancestry language, roti kapra makan. It basically translates to bread, food, clothing, and shelter. Those are the top three essentials, right? And so if you're in that space where you're providing one of those essentials, like shelter, and then within that, you're providing the most affordable form of shelter, the most affordable form of the American dream, to own a home.
Welcome everyone to our Hero Capital show. I'm your host, Tim Mai, and today I have another amazing guest on the line with us, Mr. Ali Nasir. He is a nationally recognized expert in manufactured housing communities with a lifetime of hands-on experience and a proven track record of transforming underperforming parks into stable, high-yield, inflation-resistant assets, raising a multi-generational manufactured housing community family, and is trained in commercial valuation and entrepreneurship through Harvard University's Extension School. Ali blends deep operational knowledge with strategic insights that few in the industry possess. And he is the managing partner at Rice 360 Ventures, where they help investors unlock durable cash flow, accelerate value creation, and capitalize one of the most resilient and misunderstood asset classes in real estate. And everyone, let's give a huge Texas welcome to Ali. Welcome,
Thank you
Ali.
all very much. Thank you.
Yeah.
Appreciate it.
Thank you. Thanks for being on with us today. Share with us a little bit about your background. And just I know you use the term specifically manufactured housing community and not mobile home parks. Just so everyone knows, give us a little bit of background on you and your family. Apparently, you guys go many generations with this, and why do you use it along the way? Explain why you use the term manufactured housing community versus mobile home parks.
Thank you very much, Tim. That was a long-winded introduction. Thank you for getting through all of that for me, and you did a great job with it. Before I get into myself, I want to just thank you for the opportunity and congratulate you on the recent event you had. I'm on several different threads and chat groups and whatnot, and everybody's raving about the event. So congratulations to you
Oh,
and
thank
the
you.
recent acquisition of RE Mentor. We connect on several levels that you're not even aware of. You may not be aware of, and I just, aside from our common friend Colm, and now I'm glad to see Eric on the call as well, who's done some amazing things here at Rice 360 for us. But beyond that, I've lived in your hometown of Sugar Land, Texas. I've been a member of that Sweetwater Country Club for years back in the day. And I was in Houston I landed in Houston and lived there from '08 to, it was January '08 when I landed. So right at the beginning of the Great Recession and whatnot. But anyway, and so I have fond memories of Houston and probably common friends that we could probably talk about at some point. Anyway, so the background in a nutshell, I think you covered it pretty well, but I'm eighth generation, Tim. Eighth generation in commercial
Eight.
real estate. Yes.
Wow.
And my kids who are now teenagers and the eldest is 20 are soon to be hopefully ninth generation in the business. So we go back to India to the land bartering days and land banking and whatnot. And I was able to trace it at least 8 generations back. And I'm a second generation in the manufactured housing community space by choice. By choice meaning I've experienced in our family and individually beyond I'm 56 years old, so in my all of my adult life, I've seen many other asset classes, or several at least other asset classes, and I've done M&A deals and Main Street deals and whatnot. So I've touched a lot of things, but I'm in this space for the last 45 years by choice. And to answer the term, you asked me about the terminology. We went from being called trailer parks and mobile home parks, and you name it. We were considered slumlords and whatnot. And now we've suddenly become the darling asset class, which is a side note. But to answer your question, the transition has been, I think, a great transition from the leaders of the industry to say, hey, we're really a community. This is where residents live. It's not just a park, it's a community. And these homes are not just mobile homes. In fact, once they're set in place, they're hardly mobile. You can't really move them again. It's cost prohibitive and very difficult. Why are we calling them mobile and why are we calling them parks? These are manufactured homes that meet HUD code requirements, just like stick-built homes, and they're communities where residents live and thrive. So that's the reason for the change there. Anyway, I hope that sums it up for you.
That's really good. And as you're talking about going 8 generations in commercial real estate and 2 generations in manufactured housing communities, I was thinking, why not hotels? What happened? You guys let the Patel dominate the hotel.
That's so funny. True to the tribe, we have done hotels and motels in the past. I come from the same state of India that the Patels come from, who are famous for the motels and the whole amazing transition that's happened in that space over the decades since the 70s, right? So we have done that, but I have to say, my father is a lone wolf, right? He's a serial entrepreneur, 1 in a billion, not because he comes from India, but because not just because of that, but because he's just an incredible entrepreneur. So he leveraged all the same things that you might have seen from other, just to use your example, the hotel motel space, where you still got the benefit of actually living on site when it was absolutely necessary. And I want to just emphasize that for a minute because we got into this business, Kim, right after the last Iran war. And we had, at the time, my father had, this was late 70s and early. And so at the time, we had about 120 homes in Orange County, California. And I think they're probably worth, what, $1.5 million, $2 million a home today. And so, but by 79 or 80, when the Iran war was happening, you might remember, or you may have heard of the stories where you could only get gas every other day of the week. You couldn't get gas daily. There was just that's how bad the shortage was. Interest rates, mortgage rates went to 20%.
Wow.
And so if you imagine that, so we had this house of cards, really. It was this 120 homes came down like a house of cards and collapsed overnight where people couldn't pay their rent to us, or they couldn't buy, they couldn't sell. Everything was just locked, and everything collapsed when those rates went to about 20%. And we found ourselves starting over. I was about 12 years old, and my father had great insight and intelligence to actually buy his first community. What he was able to salvage from those homes, it was enough to put a down payment on a community. And comparing to the Patel story, where they lived in motels and whatnot, we lived on site. So I lived in a trailer park at 12 years old, starting over. And it's been an incredible journey from starting with that one trailer park and building a family office over the decades, last 45 years, where, it's been thousands of units. And I don't want to get into the overall wealth or asset value, but it's been an incredible journey and one that comes as an operator. So I'm not just a sponsor, and I don't mean to reduce anybody who is, but I'm a true operator who's grown up in cutting my teeth in this space. I also went on, and I'll be brief about this, but I went on to study valuations and become an appraiser. Not for the money, because as you can imagine, the money, even as a commercial real estate appraiser, it's not great money. But the point was that I was learning all the street smarts at home, and I wanted to make sure that we also had the book smarts. So aside from formal educations and entrepreneurship academy, I went and became an appraiser to make sure I understood the underwriting and I understood it well. And I can tell you, if we have time to get into it, why I think you can make money in any real estate asset class without being a genius, and I'm certainly not a genius. But I also I'm very passionate, for lack of a better term, right now about this particular asset class and why frankly, it exceeds or supersedes all others.
That's amazing. Yeah, let's dive into that. So there's 2 things that you mentioned that I would love for you to expand on. So number one, why you love this asset more than any other assets. Number two, with what you experienced through the last Iran war, how do you think this time might affect this asset and other real estate assets with this war? Because who knows how long this war is going to go on for, right? And so I'd love to hear what your insight is. Yeah.
Sure. So why this asset class? If I don't want you to just take my word for it. For anybody listening, I want to say you can go on any AI platform and compare all the asset classes. One of our team members, Karen, did exactly that, and she went on and she compared tenant retention, operating expenses, metrics like rate cap rates and whatnot. She went across the board on about 40 different metrics to compare each and every asset class within CRE that we could. And by far, I think there was like a 70-point difference between the next asset class in terms of total points. And I'd love to share those slides with you or anyone else that wants at some point. But
yeah, if you do have it, love to see it as part of this call. Yes.
I'd love to share it. We have a saying in my language, in my ancestry language, roti kapra makan. It basically translates to bread, food, clothing, and shelter. those are the top three essentials, right? And so if you're in that space where you're providing one of those essentials, like shelter, and then within that, you're providing the most affordable form of shelter, the most affordable form of the American dream to own a home. This space has proven, and I've seen it from the Iran war that I'm not sure if I'll remember every crisis, or every downturn, I should say. But from the original Iran war, the savings and loan crisis, the I think there were some challenges in '03. I can't remember exactly what we termed it, but then you had, even before '03, you have the dot-com burst, and then
Yeah.
the '03, and so 2008, 2000, 2020 with COVID. Each and every time, and even now, going forward, to include your second question, Tim, even now with this crisis, I'm super confident that this community, this asset class remains resilient because it is providing an absolute essential at the most affordable level. And so, time and time, I always say, in a good market, our asset class is good. In a good economy, our business does well. In a bad economy, in a down economy, our business does great
Mm,
because as you come down a lifestyle notch, down the totem pole, if we
right.
all have to come down as things get more and more expensive, we're the last stop when it comes to affordable housing.
Yeah. So let's talk about like, I don't know how much you're into economics and how this war might affect real estate, but and just based on your past experience, what are you seeing in the horizon for our industry?
Thank you for asking. I'm a geek when it comes to the economics and the geopolitical issues, and I want to emphasize: yes, this war and this current issue is important. I'm agnostic when it comes to politics. It's for us as investors. It's all about arithmetic. It's all about the math, right? And what is ahead. And I also want to emphasize that it's not just the war. While our focus right now is on Iran and the oil, there's a lot of other things happening indirectly or directly because of it. For example, the yen carry trade, as Eric has talked about in the past with me, Eric Williams on the call has talked about with me, the anticipated commercial real estate defaults for all those 0% interest loans, or interest only loans, excuse me, that were written in 2020, and we've done this extended pretend for as long as we can, but those are all going to
Yeah.
be coming due. And I think that is, at least by most people's standards, at least half $1 billion in just CRE, and some people think it's far greater than that. So just the defaults that are going, and that's of course not exactly maybe not even as much in multifamily, although there is some in multifamily, but I think it's mostly in office and retail, maybe some hotel, motel, as you alluded to earlier. So those defaults, though, impact all of us, impact our ability to borrow. The yen impacts the bond rate, and of course, we all understand how important the bond rate is to our business. And so all of these things are interconnected. I think the battle that isn't spoken about with rare earth minerals and the global currency reserve status, and those kind of things that are all slowly and gradually building in the background, are all very relevant for us on Main Street, as to how it's going to impact our ability to borrow. And I think what you're going to see, what we've seen before, is you're going to see a couple things when it comes. And who knows? I don't have a crystal ball, Tim, to know when it's coming in terms of the downturn. It could be within the next 6 months, maybe within the next 18 months, but I think it's inevitable that it's coming because of the math, as I said earlier. And I think what you're going to see is when that downturn comes is an opportunity, really, for investors who are ready, investors who are liquid, investors who are willing to do creative deals and willing to step away from the herd. The herd, I believe, will be sidelined, and it's going to be up to the rest of us to be able to do creative deals. Maybe you'll see more seller financing and master leases, triple net master leases, even within my space, even within communities, as opposed to direct sales and things of that sort. So creative deals will be coming, I believe.
Wow. Okay. Share with us, because I know within the manufactured housing community, there's people that focus on strictly just the pads, just renting out the land. Some will also own and rent out the home, and some will just do owner financing. Which aspects do you focus in on? And give us some insight as to why you focus in on the part that you focus in on.
Okay, great. So I think, frankly, at the risk of sounding a little arrogant, I think my father and I were probably some of the pioneers in actually developing the business model that most people consider conventional today. We weren't the only ones, but I think we were some of the early folks doing this, and it's still being done today. It's still being done very well today now by many people. We're still doing it ourselves, but I think many have adopted it because it works. And basically, the structure is to be vertically integrated, to have everything in house, And by that, I'm saying that you own the community, of course, but you also have a dealer arm where you buy and sell homes within your community. Then, where it's permitted, and this is not legal advice, and check your own state, but where it's permitted, you might become the finance arm to actually provide retail financing of the homes that you're selling. And if not the primary financing arm, because now there are actual lenders available, there weren't when I started, then at least maybe the secondary financing for them when buyers need help with other costs like installation or transportation that aren't included in the home financing. And so of course you have your asset management and your property management built in as well. So the model is to be vertically integrated, but to keep these components separate, because and here's the main reason for following this model where the community ownership is independent of income and sales of the homes. Because once you start mixing the income from real property, the lot rent, and personal property, the mobile home or the manufactured home, you're mixing your real and personal, so you're actually skewing your valuation. And for those especially who actually rent the mobile homes out, rent the manufactured homes out, I'm going to use those terms interchangeably out of habit. But when for those who rent them on their communities, and you start mixing that rental income with your lot income, that is a big no-no. Agency loan lenders don't like it. Nobody really likes it. Bankers don't like it. Appraisers don't like it because again, you're skewing those incomes. And I think the rule by most lenders today is you can go up to about 20% of your pads with rental income like that, but generally it's frowned upon. And I suggest that you don't do it. You just keep it arm's length, like the structure I described earlier. And that has proven to work. I think it'll continue to work as long as there's vacancy in communities. And there has been, Tim. We have 5,000 communities, for example, just in California.
Wow.
And half of those communities have been 50% occupied. And not because of a lack of demand for affordable housing. We all know there's a huge demand for affordable housing, but they've been half full because the sheer upfront cost to that resident who wants to move in but can't afford the installation cost or the transportation costs or other costs that aren't directly included in the financing of the home. And so we crack that code, we break that barrier, we solve it by just essentially placing the home right there, 3-bedroom, 2-bath, cookie cutter home, ready to go with easy financing. You don't have to pick out colors or walls or paint or anything. It's ready to go, turnkey. And that's what we do, and we make it easy. And that's how we go from 50% occupancy to 90, dare I say 100% occupancy, because the demand is really there. And I have a tangent coming to mind just thinking and comparing to multifamily, so don't mind, but I'm going to say in multifamily, you have this risk of tenant retention all the time where you have constant turnover. For us, we have a heavy lift up front, but then once we have our resident, it's a resident for life. And what you're renting is really dirt because they own their home. So I don't have all the toilet, the termites, all the typical landlord headaches, but I have all the upside, the appreciation, the tax benefits, the trading opportunities, all of that, the cash flow, without all the traditional headaches. But anyway, going back to the point, what I described to you about solving that challenge and that model is being done nationwide now, because that challenge, that situation of 50% occupancy essentially has been true across the country, in primary markets, in secondary markets, in tertiary markets. And until you have the full absorption where these existing communities are fully or largely occupied, I think this model is going to continue to work. And then you'll start seeing probably development or other stuff. More of it anyway.
I see. Let me make sure I understand correctly. Are you saying that right now, as it exists right now, that there's a lot of parks, a lot of these communities are only 50% full, like 50% occupied?
Correct.
Wow. Okay. And
yeah, and that's a ballpark, 50, 60%, but there's still a lot of upside. Yeah.
Wow, I did not know that. Okay, that's brand new information for me. That's good to know. And yeah, you mentioned the reason is because the cost of these homeowners being able to buy a home, move it to the lot, all the installation, all of that. So what you're doing is you're providing a more turnkey solution where you have it there already. All they have to do is say, yes, I want that one or that other one. And yeah, so they don't need to worry about all of the moving and installation side of things.
Right.
And you mentioned that it was a challenge before, especially with insulation because it's not financeable. Is that correct?
That's right. Typically, it hasn't been included in the financing of a home for a retail buyer.
Mhm.
And
And
so,
so are you now then financing that installation in? You have a division that does that financing? Is that how you're able to, or did I miss
no, thank you.
something?
Thank you for asking. No, it just gets bundled into the cost of the home. So once the
I
home's already there, my transportation cost and the
That
installation
makes
cost is
sense.
already factored in.
That makes sense. Okay. And where do you own you as in your family? Do you own these all over the country or what are there any red state, blue state, any of that matters?
So I'm colorblind. I'll go wherever the deal makes sense. I don't like to be. I hear the term buy box, and I'm not a big fan of the term. Only I use it, but only I don't like to be limited. I don't believe in being limited for any of us. Right? We have to go where the deal makes sense, regardless of size, geography, etc. That said, Tim, I'm going to sound contradictory right now. I'm only in California right now, and
Oh,
we have yes, and I know that's probably going to sound insane to most people. But we've been in California largely active here since in this asset class since July 9th, 1981. So I think I'm in a unique position because I can have a Rolodex. I
At
have a
2 o'clock.
Rolodex
Okay.
going back
I have a
45
1:30
years.
guy and a
hold
2:30
on.
guest.
Okay.
No
Go ahead,
worries.
sorry.
Just having a Rolodex of 45 years in the industry or in this asset class and having a good fundamental understanding because as you may know, our industry is regulated state by state. There's a state level agency for our manufacturer. In California, for example, it's HCD, Housing and Community Development. And every state has their own agency that regulates this industry. And you're not going to master 50 of them. So I would suggest for people listening that you pick certain markets where you're more knowledgeable and maybe within product. I personally like it also because I like the idea of being able to drive to my investment if I can. We saw crazy things like the pandemic where you just, and sometimes flying it can be difficult. So I'm not saying I wouldn't go out of state, and I know I've done deals in Texas, like we talked about earlier. I've done deals elsewhere, but I'm really big on, unlike many people these days, I'm big on California still.
Very good. So you look for parks for communities in California that have low occupancy. You come in, you move the homes in, package them turnkey, sell them. So that's your value add, is how you increase the value of these properties. Is that correct?
That is correct. That's the standard and most compelling value add. But of course, we do CapEx renovations, a bunch you might see in other asset classes. For us, it's about the amenities like the pool or the clubhouse. It's the underground utilities that may need to be improved or upgraded. And so all of those offer a cost seg benefit, like we're benefiting today these days, like everybody else with the big, beautiful bill. And there are other improvements that we make, but yes, the homes is the primary value add.
Very cool. Okay. So these opportunity exists everywhere where there's parks, but do you see, since a lot of places don't allow you to build new parks anymore, you have to go pretty far out to be able to build parks. Is there a cap to the opportunities here, or how do you see the industry would evolve?
I'm so glad you asked. It's been cost prohibitive to build. You're absolutely right, and it's been basically we haven't seen it. But I should add that there have been some developments underway in Florida and Texas, the two other big states where you have a lot of manufactured housing communities and a lot of support for that. There's rumblings about it in California. I'm not sure if it's actually taken off yet. Historically, it has been cost prohibitive, but as the absorption happens in the existing communities and the demand stays or increases, really, I think what are they saying? We're going to have a shortage of at least 4 million housing units for as in the next year or two. And some people think that number is very low. I hear double that number. But at the minimum, we're looking at a 4 million unit housing shortage crisis ahead. So the demand will remain, and the numbers I think at some point will be justified more and more to develop. But even if that doesn't happen, what I love about this asset class, Tim, is that there's so many varying profit centers that you can have. It's almost if you want to have it be like a business, a going concern, like a
Mhm.
Main Street. For example, this is not I'm not in the RV park business by choice, although that's where we started. We started with the KOA. But an RV park meaning a typical, it's a hospitality business, right? It's a resort. It's transient resident or transient stays. And so it's not reoccurring steady income, which means it's higher risk and maybe higher reward, but it's not that steady passive business. The positive side of that business, though, is that you have daily income, you have cash flow, right? And it's like any other, almost like a Main Street business, which
Yeah.
brings in daily revenue. You can do that in the manufactured housing community space as well if you want to. And so you can start building layers of different profit centers, and whether it's the home sales or the financing notes that I talked about, but other layers as well to create additional income. And so let's say there's to just answer your question, even if the development wasn't possible, and even if all of the units were already sold and owned, there would still be ways to operate and to create profit centers and create additional income within the portfolio that you have. And I love that about my space.
That's amazing. All right. I know your family has self-fund a lot of the deals that you have done in the past, and now you're going into the syndication model. Why the change? What are you seeing? Is it a shift in the market, or are you just looking to grow faster? What's the change? Why the change in the strategy?
Well, I appreciate you having that insight already, Tim, and asking the question. The strategy is the reason for the change is very simple. My family is now, it's been 45 years. We have PTSD from that journey. I told you we lived in a trailer park to begin with, right? And it's been a tough journey. And everybody's, can I say, fat and happy now? Everybody's done. Everybody wants to be retired, essentially, most of the family members, and call it a day. And it's been a great journey, but I think we paid the dues as a family and it's all stabilized. And now we're looking at possible exits for the family. I'm 56. I have three teenagers, as I mentioned, and I'm just not, I'm still very passionate about this space, so I'm not done. So this is a way for me to transition from the family and bring the knowledge and experience to the passive or the semi passive investor who wants to get into this space, who doesn't want to spend 45 years figuring it out and reinventing the wheel. We have a playbook that works. We have innovative strategies to be, and I want to jump to a tangent if I may, real quick, Tim. This playbook works because it's been developed fundamentally. But that said, I think what I want to point out is that when things change, we're about to hit, as you've been talking about this, we're on war and the crisis, or the downturn in the economy. When things change, are you capable of rewriting the playbook? Are you capable of creating a new playbook? Because if you're just following someone else's playbook, you might get stuck.
Mm.
And I hope that the 8 generations of training, because it wasn't always wealth that was transferred, by the way. We had lost our wealth as a family at least 2 times in just the last 2 generations that I know of.
Oh,
We had lost
okay.
because of war, because of migration, because of whatever, and had to start over. But there was still a huge transfer of wealth. And I like to make that point. When people talk about generational wealth, transfer of wealth, it's always, the assumption is always that it's about capital and it's about money. And I want to say that's probably the least compelling component to me. To
Yeah.
me, and you're an example of it too, from your story and what you've come out of. It's that transfer of knowledge. It's that transfer of tenacity and ambition, the drive. It's a transfer of the values, the family values, to think generational. Those are the things that actually, the wealth may come and go, right?
Yeah.
There'll be things that are out of your control, and hopefully that doesn't happen. But if it does, it's the other things that transfer that carry you on. And so that was a tangent. Hopefully I can get back on track. But I think, and what was, help me, Tim, what was the original, do you recall the original point
Yeah,
you were saying?
now you're transitioning into leveraging retail
Oh, yes.
money, yeah, syndication. I'm curious. I was, yeah, curious about that move. Yeah.
Yeah, no, and so I think you got it. That was the reason for transitioning is, hey, now we can scale even more. I've got the playbook, I've got the understanding. I know if there's a downturn, I'm prepared to act accordingly. And let's just share this with as many people as we can and get out there and do as many deals as we can. So that's the reason I founded Bryce 360 Ventures, and here we are.
And I'm curious now when you're talking to investors, obviously manufactured housing community has never been really sexy. It's not, yeah, it's not like eye candy like a class A multifamily would be. So are
Yes.
you, yeah, how are your investors perceiving this assets and what's their feedback?
I got to tell you, Tim, as a kid, I grew up going to these industry association meetings. And at the risk of being politically incorrect, whatever, I want to say that everybody was old, that everyone was an old white male, right?
Yeah.
And I was there sitting in the room with my father and I, and then over the decades, I've been attending these, and I've seen this amazing shift in the industry. from the land banking families that had the land that converted them to manufactured housing communities or mobile home parks at that time. And then I've seen the gradual shift where we've seen REITs come in, we've seen the private equity groups and the high net worth individuals, and we've seen lenders and appraisers, everybody embrace the industry in just in the last 10, 15 years. And as that shift has happened, what's happened is there's been an education along the way. And I should emphasize that mobile home has become a manufactured home in the sense that the quality of the home and the quality of the home has dramatically improved, the stigma has dramatically reduced, right? So it's not your grandfather's trailer anymore. It's a quality home that you may not be able to tell the difference between a stick built and a manufactured home. Try to take your stick built home down the freeway at 60 miles an hour. It's just not going to survive. These homes do. And that stigma has been reduced, many thanks to the industry. And so, to answer your question, I don't even have to, I'm pretty now. I'm the darling now. I don't even have to educate my investors. Most of them, there's a frenzy coming into our space. We see so many people coming from multifamily and self storage and industrial, and all those spaces are great. But we see so many people coming for reasons that I've touched earlier and other spaces, and just including individuals, passive investors who now are aware. And so it really hasn't been a challenge for me, Tim.
That's good. All right. With the institutions coming in, I know they focus in on larger parks, right? For a new syndicator coming into this industry, what would you recommend them? Would you recommend them going after small mom and pops, stay away from the institutional, I don't know what's in the 200 plus pads or whatever that number would be, but where in that spectrum, 10 pads versus 1,000 pads, where in that spectrum do you recommend that a new person coming into the industry come in at?
So that's a great question. As a syndicator, I would say that you wouldn't be able to compete in the primary markets. First of all, it just wouldn't make any sense. You can't compete with the institutional investors there. And the tertiary markets might be a little, I don't want to say too risky, and they should not be ignored. But where you really want to live, I think, ideally, if you can, is secondary or just below secondary, 2 to 3 star parks, one being the least attractive and the highest risk, least one being the actual true trailer park, and 5 star being the one that you would imagine with a golf course or man-made lakes, bocce courts, etc. So 2 to 3 star, and for a syndicator or someone else like me, I would say at least 100 units so you have the economies of scale. But then you can make exceptions and go down to even 50 units where it makes sense, and consider a tertiary market on occasion where it does make sense. I like to position myself above the mom and pops and below the big boys, so to speak. So in the value in the range, I would suggest that somewhere between, and it used to be a wider range. I used to say 5 million to 50 million. But as the REITs and the private equity groups are coming down lower and lower, and as the Main Street mom and pops start increasing their portfolios, we're in that middle space. I would say is more like, I'll go down to as little as 3 million and up to as $25 million in asset value for a community. Maybe higher on exception, maybe lower on exception, but typically I think that's the range in asset value. And again, I think I gave you the other parameters. So that's probably the best place where you have the least amount of competition and most value add possibility.
I see. Within that segment, do you still have a lot of seller financing type deals, or yeah, is there still a lot of opportunities to be able to get these properties directly from sellers and negotiate financing within the market that you focusing on?
So I think there's less and less seller financing in the secondary markets right now, and because there's ample conventional financing available now, whereas before that's all there was really. But in the tertiary markets, I think it's still very much alive. And as I mentioned earlier, I think as the downturn comes, you probably will see a little bit more of it in both of those areas, both
I
secondary
see.
and tertiary. Yeah.
I see. Okay. Makes sense.
As the lenders back off a bit and as money tightens up, you'll probably see more. For those who are willing to be risk takers and aggressive, you'll do those creative deals with seller financing, as an example.
That's great. And what about the level of management that's needed? Let's say if you were comparing this to multifamily, for example, like how does it compare in terms of the amount of management that's needed to run these parks? these
Wow.
communities?
Wow, this you're making this easy for me to look better than multifamily, Tim. I'm sorry. But if you just think about one apartment and all of the pipes and plumbing and electrical and walls and everything you got to deal with in each of those units in every asset, that's a lot of management. With the constant turnover, it's just continuous, right? We're managing dirt. We're largely managing dirt. Sure, you may have a clubhouse or street lamps and some other things. I don't mean to reduce it just to dirt, but I don't have 100 homes, 100 units to manage all of those nuances of. And so the
Yeah.
management, it's least management intensive, which is one of the reasons I love this space.
Mm.
To give you specific examples, for example, for now, like in our current, let's say a portfolio of, I'm thinking of a specific portfolio that includes about a couple thousand units. We operate that portfolio with in-house management with a team of about 20 to 25 people. That's including boots on the ground and property managers, asset managers, everything.
Yeah.
Uh, Maybe some that, and of course we do outsource some big jobs or whatever, but it's a relatively lean operation.
I see.
And yeah, and if you look at revenue per employee or net income per employee, I think we shine.
I see. So you don't, so within your community, you don't do any park owned like rental homes at all. They're all owner owns. That
Historically, we haven't, and we don't. There may be an exception that I consider that in down the road, but generally, I've been in this business to not have all the typical landlord headaches. So historically, we haven't done it. The exception that if you want to talk about it, we can expand on it, but it would be in a situation in case anybody else is dealing with something similar in a primary market with excessive rent control and particularly desirable communities, desirable cities like coastal cities, for example, where your real estate asset value is actually been transferred to the mobile home owner because of the locked rent control or the rent because of rent control. And so essentially your value as a landowner has been transferred to the mobile home owner in that case. And in those markets, I would consider actually
mm,
doing what I consider like the multifamily model, where actually I buy those homes and rent them out. So I haven't done
I
that before, but in a downturn economy and as more and more apartments get acquired by the bigger players, and I don't want to necessarily give up a community or sell a community, that would be a strategy I would consider. So, I hope that
okay.
helps.
Yes, very helpful. All right. You mentioned earlier about some statistics that you have about the different, like how your team analyze different assets. Is that something you can share on screen, or do you want do you want to give out contact information on how others can reach out to you to get access to those slides that you mentioned earlier?
Sure, I'm happy to share all of that. And I think the best way to get it would be to get to our website. There's also, by
Okay.
the way, there's a free report on the website. It's like an 80-page detailed report about the economy and how this asset class would responds in this type of economy. So you can get that for free as well. The website is rise360ventures.com. And I think the other place you could easily find me is on LinkedIn. And I'm happy to get you the
Okay,
contact
yeah, I
information.
just posted the link to the website for everyone. Yeah, so you guys have that. That's pretty cool. I love that. All right, Ellie, for those that want to just connect with you, learn from you, possibly invest with you, we have a lot of fund managers, capital raisers on the line. So if they want to potentially come in on one of your deals and help raise, is going to the website the best way to go about it, or where would you like them to go?
Yes, I would say please go to the website and reach out to Colm McEvely, head of investor relations. You can also reach out to Daniel Nguyen, our president. Either one of those people can be the right sources. Just email them or go to the website first. I would say get the information. Maybe visit our YouTube channel as well at Rice 360, where you can see some of our decks and presentations there. It's a relatively new channel. We're trying to load up everything up there as fast as we can, but we're excited about that. So that may be another good source. But yes, reach out to Colm or Daniel, and I look forward to working with anybody here.
That's great. All right. All right, guys, we're going to open up for questions here. So if you have questions for Ali, go ahead and raise your hand digitally. Don't raise your hand physically. I won't be able to see it, but raise your hand digitally and you can ask Ali any questions you want. While we're waiting for those that might be interested in asking questions, Ali, what are you seeing are the institutions doing exactly the model that you're doing, or are they doing anything different in when they're buying these communities?
Yes, the institutional investor is playing the long game, so they don't actually follow. I don't think they follow the model of because it is frowned upon by agency lenders and whatnot to buy homes and whatnot, and it's a heavy lift. So I don't see them historically doing that executing that particular strategy, not directly anyway. So they may farm out, they may outsource to dealers where dealers can have mobile home dealers can have an opportunity to sell homes, for example. They won't do it themselves. So the net result is the same, but they're not doing it all in house like we are.
Okay.
And in the primary markets, they're probably and there's just less of that activity because in the primary markets, most of these are more occupied. They're not at 50 or 60% in the primary markets as much as they are in secondary and tertiary markets. So while you do have some turnover and there is some infill, they leave it to dealers to do. They don't typically do it themselves. Yeah.
I see. Okay. So, Ali, thank you so much for this awesome interview.